Hi everyone. Today I wanted to talk to you about asset allocation. In my personal opinion, this is the most important investing decision that you are ever going to make, at how much should you allocate to which asset. And that is what we are going to talk about today. For those of you who are attending my videos for the first time, I am Ravi Handa. I run this channel called Desi Fire Podcast, and on this I primarily talk about financial independence and early retirement. So let's dive in. The agenda for today's session is I have divided it into four broad parts. First one, do you even need asset allocation? You assess your current situation and see if it is even needed for you or not. The second one is what are some of the traditional ways that I use for asset allocation based on age, risk capacity, risk tolerance, etc., etc. Then we will talk about another interesting category, which is optimizing asset allocation, that which asset allocation will give me the best possible returns with the lowest of risk and etc. And then the last part of it would be goal-based asset allocation, which is something that I use, something that I recommend, because frankly speaking, this is the only one which seems doable to me and realistic and practical in nature. We'll dive into all of these now. So to begin with, the first one, do you even need asset allocation? And to figure that out, what you need to do is you need to check what your current asset allocation is. How much money do you have in debt? And by debt, I mean your provident fund, EPF, PPF, your savings, your debt mutual funds, your bonds, anything which is giving you a fixed rate of interest or which does not take the equity risk, so to say. The next category would be real estate, which confuses a lot of people. So how much money you have in real estate is very simple. Calculate the net worth of your house currently. From that, if you have any outstanding loan, you subtract that. So suppose you purchased a house for 1 crore rupees. Currently it is 1.5 crore rupees. You have taken a loan of 70 lakhs and it has reduced to 60 lakhs now. So then current value of the house is 1.5 crores. Outstanding loan is 60 lakhs. 1.5 crores minus 60 lakhs comes to 90 lakhs. That is your real estate exposure. Equity, fairly simple to understand. Whatever you have in mutual funds, whatever you have in direct stocks, add all of it here. Do not include your startup ESOPs or startup equity in this if you have any. Gold would mean the physical gold you have, the digital gold you have in form of sovereign gold bonds or ETFs or any other format. Do not include jewelry in it, because it's extremely rare that you will be able to sell jewelry to get money, etc., until and unless a very bad situation comes. The next category is international equity. So suppose you have any money which is where you have exposure to international companies somehow or the other, could be via an S&P 500 fund or any other route. That is another category. And then the final category is the hybrid or the multi-asset funds or NPS, for example, where you are investing in various sort of asset. So the asset allocation is taken care of by them. So you leave aside the sixth one and then you consider the top five. That is debt, real estate, equity, gold and international equity. You just consider these five and you check how much percentage you have allocated to all of them. And if you have a problem, these are some of the common problems that I've seen people have, that they have too much in retirals. That is, they have more than 50% of their net worth, which is in PF, PPF, NPS, essentially stuff that they're going to get at retirement, basically the money that is not really liquid. And if the money is not really liquid, you can't really do much about it. So you can't really make too many changes to your asset allocation if you already have more than 50% in it. So that's one of the problems. Another very common problem that I've seen with people is that they have more than 50% of their net worth in real estate. No further comments about that, but I don't really think that it's a very good idea. And then there are people who have less than 25% of their portfolio in equity. So if you have any of these problems, I don't really think you need to worry too much about asset allocation. Because if you are in this situation, then, a couple more assumptions. A, you have more than 5 working years left. So this is not someone, who is about to retire or who has retired. And you have more than 2 years of expenses in absolutely safe liquid assets. Anything above 6 months is fine, but let's say be conservative and let's stretch it to 2 years. If you meet these conditions, that is, you have any of these three problems, that your retirals are more than 50%, or real estate is more than 50%, or equity is less than 25%. If you have any of these issues, just put 100% of your money in equity. That is, whatever money that you are saving, don't look after asset allocation. Don't think about how much I should allocate here and there. Just put all your money in equity, irrespective of the market conditions, whether the market are at the top, market are at the bottom. Because your exposure to equity is so low that until and unless you keep putting in this 100% in equity for a reasonably long period of time, you're not going to fix these problems. Your retirals are not going to come down because, from your salary, your PF will still get deducted, your NPS will still get deducted. The real estate exposure that you have, if you have an EMI going on, that will also keep on increasing because you are allocating money to that. So, if you are in a situation like this, you don't really need asset allocation. In a situation like this, I would just suggest whatever money you are saving, just put 100% in equity, and that would probably work for you. Now, this is essentially for people who don't really need it. But let's say you don't have any such problems. You are in a comfortable position, you have a decent amount of liquid net worth, and then you need to look at asset allocation. Well, there are some traditional ways that people tend to use. One of them is based on age. That is, suppose you are 60 years old or 50 years old, you subtract that from 100, whatever is the percentage that is left, that becomes your equity exposure. For example, if you are a 37-year-old, then 100 minus 37, that is 63%. 63% of your net worth should be in equity. Some people, instead of 100 minus age, recommend using 110 minus age. Not a big fan of either of these, but yes, something is better than nothing. So if you do not have any logic or basis to what you are doing right now, maybe this is a good idea for you. Something is better than nothing. At least you will have some sort of a plan, some sort of a method for asset allocation. So something is better than nothing. I don't really think this is very practical or easy to do because you'll have to rebalance every year. I don't really know how honestly and how diligently you will be able to do it. There might be taxation issues as well. I don't really think that it's very practical. And it also does not take into account of your personal situation. Now, you at 35 will be very different from what my financial position is at 35. Both of us cannot have the same asset allocation. It needs to be deeper than that. The other ideas which I have seen are based on concepts like risk capacity and risk tolerance, which essentially mean, risk capacity is how much money you have, and based upon that, how much risk can you take, how much of a fall your portfolio can take care of. Risk tolerance is more on the psychological front that, if you have 10 crores and if you lose 3 crores in 6 months in the equity markets, will you be able to handle it? Which is quite possible if you think about it. Losing 30% in a year is not unheard of. So that is the risk tolerance part. Again, I don't quite believe in these ideas because your risk capacity and risk tolerance, they sort of keep changing. It's not really, that you will always be at a low risk capacity and a low risk tolerance, and it becomes very, very difficult. This particular graph that is there on the screen, that I have captured from moneycontrol.com, and I don't quite buy it, but this is what they had suggested for someone who has a low risk capacity and a low risk tolerance: 80% in debt, 10% in equity mutual funds, and 10% in gold. For someone with a high risk capacity and a high risk tolerance, they had suggested 15% in real estate, 55% in equity mutual funds, and 30% in direct equity. First of all, I don't like this fundamental idea of separating equity mutual funds and direct equity. They are essentially the same asset class. It's not really giving you any form of diversification, whether you're putting it via a mutual fund or you are doing it on your own. You'll end up investing in more or less the same company, the same type of assets. I don't get this, but this is one of the options out there. Once again, if you are not doing anything, please do this. This is better than doing nothing. The other ideas are flat ideas. You ask someone, he says that, what you do is you go in for a 50% equity, 50% of a debt ratio, or you should follow an 80-20 sort of a debt ratio, 80 equity, 20 debt sort of a ratio. If you're still earning and you want to invest aggressively, blah, blah. Again, If you can maintain this, if you can do this, 60-40 or 70-30, depending upon what your condition is a reasonable idea. Some of the examples that I found on the internet: for a traditional retiree, which is someone who is retiring at 60 and he is sort of the conservative side, a 30% equity and a 70% debt is recommended. On the other hand, the other end of the spectrum would be someone who is still earning, has a lot of earning years to go, and is an aggressive investor. Maybe an 80-20 is a good idea. That is 80% in equity and 20% in debt. Not a big fan of these strategies, once again, for the simple idea that they're difficult to do. It is incredibly difficult to pick up an asset allocation and stick to it, irrespective of what the condition might be. You need to be a little bit flexible, and you need something that is easier to execute in nature. But for those who want really the textbook perfect sort of a thing, okay, just tell me what works best, that is when you can get into optimizing your asset allocation, and that becomes really, really interesting. I looked up a lot of articles, a lot of videos. The best one that I could find was, I think it was an article by Anup on capitalmind.com. From there, I have got this data. So what he has taken is, he has considered 6 hypothetical asset allocations. One is token asset allocation, where they are putting in 70% in domestic equities, 10% debt, 10% gold, and 10% in US equities. Then they have looked at a textbook asset allocation, where 50% in domestic equities, 20% in debt, 10% in gold, and 10% in US equities. Safety first, so as the name sounds, low risk, 40% in domestic equities, 50% in debt, 10 in gold, and 0 in US equities. Equal, 4 asset classes that they have considered, 25% in each one of them. Goldfinger, that is a gold heavy portfolio, that is 50% domestic equities and 50% gold. Stars and Stripes, that is 50% domestic equities and 50% US equities. So they looked at these 6 asset allocation over a period of 30 years. I think the data that they are looking at is 1990 to 2020, and this is the results that they got. Obviously, the one which had the highest amount of risk, which was 100% equity sort of a portfolio, 50% Indian and 50% US, that has done really, really well at a 16.2% CAGR. The gold one has done a 15.7%, and the lowest one is around 12.3%, which was in the safety first portfolio, presumably because that has the highest debt allocation. But we can't really just blindly look at returns over a 30-year period. We also need to look at what sort of risk came along with it. And the risk that came along with it is given in the volatility summary. So what you will see is that the safety first one had the least amount of volatility, whereas the pure Nifty one had the highest amount of volatility in nature. So which one should you pick? Well, if you ask me, based upon this data that is given to me, I would probably go in with the textbook sort of allocation. And the reason for that is textbook has done fairly close and a little better than a pure Nifty, sort of a 100% Nifty allocation. But it has done that with lesser risk. If you look at it, if you look at versus safety and equal, these are the only ones which are beating it on the risk parameters. So the textbook one turns out to be the safe one, third on the safe one, and third on the returns one. Otherwise, these two, which are giving us the highest returns, if you want to go just by returns, they are doing pretty poorly in the risk department. So if I want the highest sort of returns with the lowest sort of risk, based upon this data, based upon what Anup at Capital Mind looked at, textbook asset allocation comes out to be the best, which is 50% in domestic equities, 20% in debt, 10% in gold, and 20% in US equities. Great idea. You can do this optimization. Good for you. Please go ahead and do it. Personally, I find it a little bit difficult to execute. And at the end of the day, the best strategy for you is going to be what you can execute easily. If you can execute an 80-20 easily, go for that. But what I found works best for most people, including myself, and that's something that I have been trying to follow. I'm not saying that I consciously and fully follow this, but at least what I try to do is a goal-based asset allocation. Here is what I mean by that. I figure out what that money is for. For example, if that money is for an emergency fund, That is, I need it anytime, I cannot risk it. It is a small chunk of the portfolio, I'll not have a lot of money in my emergency fund. Then the instruments that I'm going to use for it are going to be debt heavy or debt based instruments, that is a savings account, a liquid or an ultra short term debt fund or fixed deposit. So this particular one will be 100% debt sort of a portfolio. On the other hand, if I'm looking at something like a purchase of a house or a car, and that is something that I need to do in the next 2 years or 5 years or 7-8 years, then that is what is going to define my asset allocation. If it is something that I plan to purchase in the next 2 years, I'll keep the money in short-term debt. I'll not really go with FDs because the amount is very, very high. A short-term debt fund would do the job, but that is still debt. 2 to 5 years is the period in which I'm looking to buy that house or that car or any big expense. I'll probably put it in a hybrid fund. A conservative sort of a hybrid fund because I don't want to take too much risk with it, but I don't want to be completely left out of the market as well. On the other hand, if this is something that I plan to do maybe 5 years, 7 years or a long time later, then I will put 100% of the money in equity, and as the goal gets closer, I will move it to maybe a hybrid fund category or maybe a pure debt category. So based upon the time that is needed for this particular goal to be achieved, that is how I'm going to allocate this. Very similarly, kids' college is another very common goal that people have. The problem with saving for your kids' education is you don't know what the kid is going to study. So you have absolutely no idea how much it is going to cost. You don't know whether the kid is going to study in India or it's going to study US, and that's going to be a big impact on what the costs are going to be. Another part which a lot of people tend to neglect is that they think, oh, I'll need 25 lakhs for my kids' education or I'll need 1 crore for my kids' education. Please understand that you will not need that in one go. You will need that money stretched out over a period of 4 years and in some cases 6 years, because you might want to finance your kids' graduation and the post-graduation. So it is not that money you are getting in one go. It's not that you need to write just one check. You will need that money over a period of 3 to 6 years. So what should you do? So if your kid is class 10th or below, there is very little clarity on how much money would be needed or what needs to be done. Whatever amount of money you have, just keep it 100% in equity. Post 10th, you start moving towards hybrid funds because after 12th, your withdrawals will start. So you'll have that 2-year window, and you need to continue in hybrid funds because the withdrawals will go on for a long period of 3 to 6 years. So from 10th, it could be an 8-year period, 2 years till 12th, then 4 years of graduation, then 2 years of post-graduation. So you have an 8-year window. In that 8-year window, you cannot remain completely out of the market and you cannot depend completely on the market because you will need to withdraw that money. So that is why hybrid funds become the answer for this particular goal if your kid is not in class 10th or, so if the kid is in class 10th or above, class 10th or below, probably 100% equity is the right idea. Then comes retirement, another very important goal that people have, and on this particular channel, that's what I mostly talk about. If you have more than 5 working years left, you're saving, you have a long time and you're saving a shit ton of money. Just put 100% of your money, whatever you have earmarked for retirement, in 100% equity. And in this 5-year period, yes, there might be a downturn, there might be an upswing. You will make money in this. This is a long enough period. If you have 0 to 5 working years left, then probably an 80-20 ratio is fine for whatever new money that is coming in. So you keep putting in money, some portion of it, 80% of it in equity and 20% of it in debt. On the other hand, if you are retired, an early retiree or a traditional retiree, then probably a bucket strategy works best for you. I have shared my personal bucket strategy in one of the earlier videos, which I will link in the description, and I'll probably make another detailed video on bucket strategy as well. The basic concept of the bucket strategy is that whatever money you need in the next 2 to 4 years, you keep it in debt. Whatever money you need in the next 4 to 6 years after that, that you keep it in assets which sort of match inflation, maybe sovereign gold bonds, maybe high dividend yielding stocks, or maybe hybrid funds. And then all the money over and above that, that is not there in your short-term or your medium-term bucket, all the money in the long-term bucket essentially goes into equity or real estate or any assets that you believe can beat inflation over the long run. And that's pretty much all that I have to say about asset allocation. I hope you guys like this video. In case you want to discuss anything with me or you want to reach out, you can reach out to me via my email, that is ravihanda@gmail.com. I'm also available on Twitter with my Twitter handle being @ravihanda, and I'm also there on LinkedIn. Hope you liked this video. If you haven't, please do, and please subscribe to our channel as well. Thank you.